All right, welcome to another deep dive
Hey.
where we take all those sources that you listeners send our way
Right.
and pull out the key knowledge, the stuff you actually need
Right.
without, feeling totally overwhelmed.
Yeah.
Think of this as like your shortcut to getting well informed on
Yeah.
pretty much any topic,
Yeah.
really.
Absolutely.
So today we're going deep into the world of the stock market.
Okay.
Specifically, some excerpts you sent us from John L. Person's book,
Yeah.
published, I think it was 2013,
Okay.
Mastering the Stock Market,
Sounds good.
along with some really interesting questions you had about
Whoa.
combining like all these different trading tools and developing, solid exit strategies
Yeah.
and all that.
That's a big one.
Yeah.
Yes. So our goal today is to really dig into Person's approach
Yeah.
to what he calls high probability market timing
Okay.
and stock selection.
Yeah.
But we want to go beyond just, describing what he says in the book
Yeah.
and really explore how relevant are these ideas today?
Right.
How could you think about applying them, in a practical sense?
Yeah.
And we're going to do all that based on the material that you
Right.
sent over to us. So,
Perfect.
yeah.
All right, so let's unpack this.
Okay.
First off, the book itself,
Yeah.
Mastering the Stock Market,
Right.
came from John Wiley and Sons.
Okay.
Does that name ring a bell?
It does. Yeah. They've been around forever.
Yeah, they've been publishing since like way back in 1807,
Wow.
which, I mean, that tells you something right there.
Yeah. They're doing something right.
Yeah.
For sure.
They're not, fly-by-night operation.
Right.
And they also have this Wiley Trading series, which is pretty cool.
Okay.
It features insights from traders who've,
Yeah.
navigated all sorts of market ups and downs.
Right. Yeah. Through all the different cycles.
Yeah, exactly.
Different environments.
And just to keep in mind,
Yeah.
this book was copyrighted in 2013.
Okay.
So the strategies that we're going to be talking about
Right.
were, developed and presented within that specific market environment.
Yeah. That's an important point.
Yeah,
Context is everything when
Yeah.
we're talking about markets.
absolutely.
And right from the start, Person lays out his long-term
Okay.
bullish view on stocks.
Okay.
And this is from the March 2009 market bottom
Uh-huh.
all the way into the 2012 presidential election period.
Interesting.
What I think is interesting here
Yeah.
not just the prediction itself,
Right.
but the reasoning he uses to back it up.
Right. Yeah. He's
Yeah.
got to have some kind of justification.
Exactly. Yeah.
So what's he basing this on?
So he highlights this interesting situation where the tech-heavy indexes, like the QQQ and the NASDAQ Q100,
Right.
they made a low in March of 2009
Yeah.
that was actually higher than
Yeah.
their lows back in November of 2008.
Oh, interesting.
So that's kind of a clue right there.
Okay. Yeah, that's unusual for sure.
And then he points to a bunch of different sentiment indicators.
Okay.
Things like the CFTC, COT reports,
Right.
volume studies,
Yeah.
and then his own person's pivot support levels.
Okay. So he's got his own
Right.
custom indicator.
he's developed.
Yeah.
And these are all suggesting this kind of continued bullish momentum.
Okay. So a lot of things are
Right.
lining up.
Yeah, it's not just,
Right.
one thing.
Yeah.
He's looking at the weight of the evidence.
Oh,
And then what I think is really interesting is it's not just a gut feeling for him.
yeah.
He actually lays out his fundamental reasons
Okay.
for this optimism.
Okay. So what are those reasons?
So he talks about the ongoing march of technological progress.
Okay.
The increasing interconnectedness of global markets and, just that basic human desire for a better future, for prosperity.
Yeah. Those definitely seem like pretty
Yeah.
solid long-term trends for sure.
Absolutely.
Yeah.
However, he does include a really important disclaimer,
Okay.
acknowledging that his outlook could change
Right.
if those underlying drivers
Yeah.
and the signals from his indicators shifted.
Okay. So he's not saying this is like
Right,
a
exactly.
guaranteed thing.
Yeah, he's not saying it's set in stone.
Right. It can change.
Absolutely.
Gotcha.
He's got to be flexible, right?
Makes total sense. Yeah. The market is always evolving.
Always.
All right. So
Yeah.
let's talk about picking individual stocks.
All right.
He makes this point
Yeah.
that during this kind of developing business cycle,
Right.
a buy and hold mentality for a period of time will pan out to be a stock picker's best friend.
Interesting quote.
Yeah.
So what stands out to me here are
Yeah.
the specific sectors
Okay.
that he flags as having potential for longer-term growth.
Okay.
Things like wealth management, real estate,
Right.
energy, communication, technology,
Right.
food, and healthcare.
Those are pretty big sectors.
Yeah, these are major parts of the economy.
Yeah, for sure.
And what I think is really smart
Yeah.
is he connects this back to
Nice.
the bigger picture.
Okay.
He links these directly to, just the growth of the global population
Yeah.
and rising levels of education worldwide,
Okay.
suggesting that there's going to be this persistent demand
Right.
for these areas.
So thinking long term.
Exactly.
Yeah, that's
It
interesting.
makes you wonder, looking back,
Yeah.
how accurate were those predictions
Right.
and what new sectors might be on a similar
Right.
long-term trajectory today?
Like, what are the new sectors that are emerging that might have that same
Right.
kind of long-term potential?
Yeah, that's a good question to think about.
Absolutely.
Yeah.
But he's not just saying, throw your money at any stock
Yeah, absolutely.
in these sectors.
Yeah,
Oh.
he really emphasizes that.
Yeah.
The key is identifying the right stocks
Uh-huh.
within those right sectors
Right. It's got
and getting in at the right time.
yeah, the right stock at the right time.
That's the puzzle everyone's trying to solve, right?
Yeah, that's the holy grail of investing, I guess,
Yeah.
for sure.
Yeah.
Okay, so
Okay.
how do we go about finding those right stocks?
So this is where he introduces technical analysis,
Okay.
and he presents it as this factual
Okay.
and, importantly, an unbiased
Okay.
way to look at the market.
Okay.
So what I find fascinating here
Yeah.
is his emphasis on using the information that the market itself provides.
Uh-huh.
So we're talking about the highs, the lows, the close,
Mhm,
the opening prices, along with
Yeah.
the volume of shares traded.
So you're just looking at the price action.
Exactly.
Yeah.
We're looking at what the market's doing,
Right.
not opinions,
Right.
not external news,
Yeah, just the hard data.
just the hard data.
Yeah, okay, that's interesting.
Yeah.
All right, so then he transitions into talking about
Okay.
exchange-traded funds
Yep.
or ETFs.
Yeah, ETFs.
For anyone listening who, might not be totally familiar with ETFs,
Yeah.
how does he describe them?
So he describes them as a sort of hybrid investment vehicle. They have characteristics of both
Okay.
mutual funds and stocks.
Yeah.
So they can hold a basket of stocks
Right.
like a mutual fund,
Yeah.
but they also trade on exchanges throughout the day,
Yeah.
just like individual company shares.
Okay, so they're kind of a mix of both.
Exactly.
Gotcha.
So this gives you the benefit of diversification,
Okay.
within a specific sector,
Yeah.
or even a futures contract.
Okay.
But you have the flexibility of, intraday trading,
Right.
and even the ability to sell them short if you want to.
Okay, so you've got some
Right.
more flexibility with them than a mutual fund.
Yeah, you've got more options,
Right.
so to speak. Yeah.
Literally, yeah.
Literally, yeah.
Okay, so for
Right.
someone just starting out or maybe looking for, a simpler way to diversify,
Right.
what are some of the practical advantages he points to?
So he highlights that ETFs typically have lower operating expenses
Okay.
compared to traditional mutual funds,
Gotcha.
often because they don't have those 12b1 marketing fees.
Okay, so that can eat into your return.
Yeah, absolutely.
Yeah. So he emphasizes how easy they make diversification.
Okay.
You can get exposure to an entire sector
Right.
with single purchase.
Right.
And they're generally low expense ratios
Yeah.
make them, pretty accessible tool
Okay.
for a lot of investors.
For sure.
Yeah.
Okay, so if you're looking for, diversification
Yeah.
and low costs,
Yeah.
ETFs can be
That's
a good option.
Yeah, a good place to start. Yeah.
Okay, now for those who might be,
Mm.
looking to add a bit more complexity or
Yeah.
maybe have, specific hedging needs,
Right.
he digs into the options market.
Oh, right. Yeah. Options.
And this can sound pretty
Yeah.
intimidating, I
I
think,
can. Yeah.
to a lot of people.
Yeah, absolutely.
How does he kind of frame it?
So he introduces options as
Right.
what are called derivative products,
Okay.
meaning that their value is derived from an underlying asset,
Okay,
like a stock.
gotcha.
So he explains that they can be used either to protect your existing
Right.
stock holdings
Right.
against potential downside,
Right.
or as a strategy
Yeah, yeah.
to essentially replace
Okay.
owning the stock outright,
Okay.
often with less capital.
Okay.
He does mention the standard risk disclosure
Yeah.
that comes with options.
Yeah, there's always going to be that.
Of course, yeah.
Yeah.
But he makes this really interesting point.
Right.
He actually suggests that simply buying and holding individual stocks
Right.
can actually carry more risk
Oh, okay.
than strategically using options.
So options can be a way to reduce risk.
In certain situations, yeah.
Okay.
Yeah.
That's pretty interesting.
Yeah.
So can you give us an example from the book that kind of illustrates this?
So he uses the example of Google,
Okay.
ticker symbol GOOG back then.
Okay.
And this was right before their...
Earnings announcement on January 19th, 2012.
Okay.
The very next day,
Yeah.
the stock price dropped
Okay.
8.25%.
Wow. So a big move.
Yeah, significant drop.
Yeah.
Yeah.
And so what's insightful here is that he explains how an investor who was already long on Google could purchase a put option.
Right.
And a put option gives you the right to sell the stock at a specific price.
Okay.
So it's basically like insurance against the price going down.
Gotcha.
And the cost of this protection, especially with a short-term weekly option, would have been relatively small compared to the potential loss of just holding the stock through that earnings event.
You can limit your downside.
Exactly. Yeah, it's a way to manage risk.
Okay, so options aren't just about, speculation.
Right.
It could be a tool for managing risk.
Absolutely. Yeah. That. All right. Next, he discusses seasonal analysis.
Yeah.
And this isn't something that comes up, every day.
Not in your typical market discussion.
Right. Exactly.
Yeah.
So what is this?
What's fascinating about seasonal analysis is the idea that you can identify recurring patterns.
Okay.
Where a particular sector or asset class tends to perform in a certain way during specific times of the year.
Okay. So there's these seasonal patterns.
Exactly.
Yeah.
Yeah. So he basically frames it as creating a shopping list for when you might want to consider buying or selling with the aim of positioning yourself in advance of a potential market move.
Gotcha. So you're kind of front running it.
Yeah, you're trying to get in before the move happens.
Right. Okay, I get it.
Yeah.
And he even gives us a
little peek into some of these historical tendencies.
Yeah, exactly. So he refers to table 2.1 in his book.
Okay.
Which points to potential long entry opportunities. In 10 out of the 12 months. With May and August being the notable exceptions.
Okay, so May and August are bad.
Well, this brings up the well-known saying, sell in May and go away.
Right, I have heard that one.
Right. So he attributes this to Yale Hirsch and the Stock Traders Almanac. And they suggest that historically, May often marks the start of a weaker period for equities.
So it's kind of like the summer doldrums.
Yeah, it's kind of like people are on vacation.
Yeah, exactly.
At least trading.
People are, doing other things,
right.
Graduations, weddings, and things like that.
Yeah, okay.
Yeah.
So it's about recognizing these kind of cyclical patterns.
Yeah, and recognizing that, markets don't always follow these trends perfectly.
Right, so it's not a guarantee.
Exactly.
It's just something to be
one piece of the puzzle.
Right, gotcha.
Yeah.
Okay, so then he talks about sentiment analysis and this concept of contrary opinion.
Yeah, contrary opinions.
So how does that fit into his overall strategy?
What's interesting about contrary opinion is the core idea. That when you see a really strong consensus building in the market, especially when it's amplified by the media after, a big price trend, it can actually signal a potential opportunity to take the opposite side of that trade.
We are going against
Exactly. Yeah, so the logic is that by the time everyone is, super bullish or super bearish, the move might be running out of steam. So he mentions that there are all these different sentiment indicators that can be really useful in helping to identify these potential market tops and bottoms.
Gotcha.
Yeah.
So it's kind of like being a contrarian.
A little bit, yeah.
Yeah.
Okay.
Then he digs into the commitment of traders or COT report.
The UT report.
And this is something that, a lot of more active traders keep an eye on.
Absolutely.
So what are the key things that he highlights?
Okay, so the COT report basically gives you a breakdown of the aggregate positions held by three main categories of traders in the futures market.
Okay.
So we have commercials.
Yeah.
And these are often, big companies who are using futures to hedge their business risks.
Okay.
We have large speculators.
Okay.
Like hedge funds and other, big money managers. And then we have small speculators, which are generally, your typical retail traders.
Right. So it gives you a breakdown of
exactly
who's holding what.
Yeah. Who's long, who's short.
Okay. So what are the key things?
And one really important thing to understand is that this data is collected every Tuesday.
Okay.
And then it's released to the public on Friday afternoons.
Okay.
Eastern time.
Gotcha.
So there's always a bit of a time delay.
Yeah. So it's not real time.
Right. It's not real time data.
Right.
And that's super important.
Yeah. That could definitely make a difference.
Oh, absolutely.
Yeah.
Especially if you've got, a fast moving market.
Yeah.
And there's been a big price swing between Tuesday's close and Friday's release.
Yeah. That data could be
stale.
Yeah. Pretty outdated.
Exactly.
Yeah.
So he points out that when you're looking at the COT report, there are several key data points to pay attention to.
Okay, so what are those?
So the first one is total open interest.
Okay.
And that basically tells you the total number of outstanding contracts.
Gotcha.
So that's one thing to look at.
Okay.
Then you want to look at the percentage of long versus short position held by each group.
Okay.
So are the commercials net long or net short?
Right.
Are the large speculators net long or net short?
Sure.
You want to look at the net change in their positions from the previous week.
So are they adding to their positions?
Exactly. Yeah.
Are they reducing them?
Are they getting more bullish, more bearish?
Okay.
You also want to look at historical COT data.
Yeah.
And you can even use moving averages of that data to compare current readings to past extremes.
Okay, so you can see how things compare historically.
Yeah, are we at a really high level of bullishness or bearishness, or are we somewhere in the middle?
Okay. Yeah.
And he gives some specific examples.
Yeah. He highlights the market lows of March 2009.
Okay.
Where the COT report showed that small speculators had built up a significant net short position in many contracts, while the large speculators were holding substantial net long positions.
Oh, interesting.
So that's...
so they were on opposite sides.
Yeah, that's a classic contrarian setup.
Yeah.
Yeah.
And what happened?
Well, the market went up.
Okay.
So the big money was right.
Yeah, the large speculators were right. Gotcha.
He also points to the S&P 500 rally from December 2011 to February 2012.
Okay.
Where, again, small speculators were largely on the wrong side of the market.
So it seems like the little guys?
Yeah, the small speculators.
Yeah.
They tend to be wrong at the extremes.
Yeah, kind of get caught up in the...
Yeah, they get a little too emotional.
Yeah, maybe. Yeah, for sure.
Yeah.
Okay, so this COT report can be...
It can be a valuable tool for gauging potential turning points or to confirm the strength of an existing trend by seeing if, the smart money is aligned with it.
So it's almost like you're trying to see what the big guys are doing.
Yeah, the more sophisticated players are doing.
Exactly.
Yeah.
Yeah.
That's pretty cool.
Yeah.
Okay, next up, we've got relative strength, or RS analysis.
Okay, yeah, relative strength.
How does he explain what this is all about?
So he describes relative strength as a way to compare the performance of one investment against another.
Okay.
So this could be a single stock.